So good morning, ladies and gentlemen. It's a wonderful morning. Thank you to be with us today, this morning, for our FSMOne mid-year review. It's an honor to stand here. But standing right here, right, in this auditorium room, it actually kind of reminds me of my uni day, attending a lecture, right? A lot of you are nodding. Yes, it actually reminds you as well. So what make it different is now I'm standing right here. Instead of sitting at the back at the last row last time, now I'm standing here. It makes me a bit nervous, and you might have noticed my voice is kind of shivering right now. Fret not, I'm going to bring you a very interesting topic today. The recommended fund of 2026-2027 and our ETF focus list. I believe everyone is attending this event today is because you are interested in investing. It's not just like, it can be like you just started investing, you don't know where to start, or you have been investing for a while. You think that, maybe I should make some changes to my portfolio. So I hope today's recommended fund and ETF focus list can actually provide you some reference, and maybe some of the fund I mentioned can be in your portfolio. So before I begin, the first slide, okay, a simple disclaimer. Past performance doesn't indicate future return, hence please conduct your research before investing. Well, just now, I believe if you guys focus in Su Cheng and the MC mentioned, right? There's over 1,000 of unit trust fund in our platform. Last time was 900, now it's 1,000. If I ask you to read a 900 pages of book, what will you do? Or like just close the book and then go to sleep, right? So instead of looking 900 funds, we help you to do assessment and pick out the 43 funds. And I know everyone want to know what are the funds inside those 43 names. Fret not, be patient, we'll move further. In the speech just now, there's one number that everyone is very excited about, 18.8%. It's the average return of our clients' funds from June 2025 to May 2026. If average is already 18.8%, is our recommended fund performing better than that? And the answer is yes. Our recommended fund list in 2025-2026 actually bring you to 3-year cumulative excess return of 4.6% versus their peers average. It means that if a group of fund have a 10% return, on top of that 10%, the recommended fund actually outperform with another 4.6% of return. Just now my disclaimer say, past performance doesn't indicate future return. So why do you mention this number? The answer is because this number is showing us the recommended fund list is moving at the right direction. We are picking the fund that perform well in the long-term 3-year. Well, this year, I mentioned, we have narrowed down from 900 funds to 43 unit trust fund. 43 still sounds like a big number, but the case is because today we have more than 300 participants with us. Every investor, they have their own risk profile. They have different preferences. Some of you like US market. Some of you love local market. We love Malaysia stocks. That's why we designed this list to cater across 35 categories. So, before I move into the actual list, some of you will be wondering how you actually pick. There's 900 fund, how you choose it. So, let's move to our website. If you are curious about how we choose it, right? There's actually the methodology available on our website. This is the actual page. You can open your phone, go to FSMOne website, look at the methodology, and I'll bring you through this website together. Scrolling down, you'll see there are 3 quantitative pillars and 1 qualitative overlay. You ask, as an analyst, shouldn't you be just looking at numbers? Numbers tells you everything, right? But in this recommended fund list, that's not the case, and I'll explain further with you. But we'll continue to scroll down. You see this chart. Why is there differences between equity and balance fund and bond fund? The reason being that we assign 60-20-20 ratio to the equity and balance fund for return, expense, and risk. Meanwhile, for bond fund, we assign a 40-30-30 ratio. This is because for bond fund investor, usually you guys are seeking for capital preservation. Hence, when you are investing, you need to consider about the cost of me as an investor. How much do I pay to invest to get a stable return? And on top of that, you want a stable return. You want less risk, less volatility. That is why we emphasize more of expenses and risk for the bond fund. If you scroll down further to the list, here comes the 3 quantitative pillars. The first one, return. It's not just a simple question of asking, how much this fund give me return in the last 1 year? No, it's just not just a simple one number. But the full picture is actually built on top of calendar year return, cumulative return, and average 3-year rolling return. What we are looking here is a stable return. A fund can perform very well on 2021, 2022, 2024, but what if the fund underperformed during 2023? As an investor, will you be patient enough? Will you stay invested when the fund underperformed their peers so much? The answer will likely be no. That is why we want to find a fund that has consistent performance so that investor can stay invested. Further down the list, we go to the second metric we have, risk. Just now I've mentioned about stable return. So when market is good, right? All investors are very happy. Wow, it's a bull market. I'm getting a lot of return. But when market goes down, investors get panicked. Your fund is losing like 10%, 20%, 30%. Questions comes out. Should I stay invested? If I keep investing, am I going to lose more? So those are the questions when market goes down. So volatility become a very important thing for investors to look at. That is why we combine volatility, downside volatility, and maximum drawdown. For maximum drawdown, we try to look at from the peak until the fall, how much does that particular fund perform? It's a drawdown, very huge one compared to their peers. They draw down like 30%, while other peers only 20%. We wouldn't want to pick the 30% one, right? That is why we have this metric. And on top of return and risk, we have our third pillar, which is the expenses. A lot of investors actually overlook this because expenses, it actually covers the management fee and also administration costs and any other fund-related costs. So when you are investing in a fund, you are not just looking at the risk, not just the return, but holding a fund actually costs you something. The more it costs you means the lesser return you get to keep in your pocket, right? So expenses, it's part of our consideration as well. So just now I talked about like quantitative numbers. As an analyst, I'm very familiar with those numbers. Then why do you need another qualitative layer? It seems like when you are picking your husband, your wife, or your partner, you're not just looking at what is their number on the payslip, right? You also need to know their personality. Same with the fund. You want to know the fund personality. That is why, as a platform, we have this privilege to actually talk to the fund manager. How they manage this fund, how they do all this allocation. At the same time, we can ask for their view to certain market. When market change, how are they going to react to the fund? So, on top of those discussions, we also look at something such as fund size. Fund size is actually an important part because a smaller fund, they tend to have a slower growth. On top of that, a smaller fund sometimes bring our investor liquidity risk. Well, for qualitative part, there's a lot of discussion that happens when we are choosing. I won't be able to go through everything with you, but here summarize it. Well, I've talked about quantitative, qualitative, how we choose the fund. So let me jump back to my slide, the 43 funds. Finally, we are coming to the actual list. In the top of the list, you see core equity. If you are a global investor, we have the MAMG Global Dividend Fund for you, which again, today I have 43 names. I won't be able to go through every single one of it with you, but I'd like to highlight a few that I think you guys will be interested in. The first one, Asia market. We know that Asia market has been rally Everyone has been talking about Samsung, SK Hynix. If you talk about semicon, you always hear the name TSMC. All those equities are actually invested in Manulife Asia Pacific Opportunity Fund. On top of that, as an analyst, right, I've been covering Malaysia and Japan market. I like Japan market. They've been going through their governance reform. On top of that, we can see their economy is improving. Their wages is growing up, and Japan is a very interesting country because they have a lot of interesting names. I think the most familiar one would be probably Sony, there where a lot of people like their camera, a lot of people like their game. So if you're interested in Asia market, Manulife Asia Pacific Opportunity Fund will be your option. And we can see from the graph, they have a very outstanding performance as compared to their peers. They have been always outperforming. At the same time, they have a lower volatility and lesser drawdown. On top of Asia, some of you like US name. Maybe some familiar names, iPhone, Apple stocks that we all have been holding iPhone, right? On top of that, if you work in an office, you probably use Microsoft. Those are actually the US tech name, and they are actually be invested from the United Global Transformation Fund. So this fund is actually a very diversified fund. They not only have US name, they are also been investing in Taiwan, Netherlands, and many other countries. If you like global tech, this fund is for you. And it also have a very strong track record against their peers. So, as a Malaysian, right, I love Malaysia equity. So that's why we have 3 funds for you. Genanga Blue Chip Fund, CAF Core Income Fund, Eastspring Investment MY Focus Fund. You ask, Malaysia is just one country. Why do I need 3 funds? The answer is these 3 funds serve different purposes. Genanga Blue Chip Fund, they invest in the blue chip name that we are very familiar with, such as like Maybank, while CAF Core Income Fund, they invest in broader Malaysia equity, but their outperformance actually comes from the small and mid-cap companies. While Eastspring Investment MY Focus Fund, they are also representing the broader Malaysian equity. That's why we have 3 options for you, catering different investor needs. While moving forward down the list, we have core fixed income. Some of you like a stable return, less volatility. Fixed income is a very good option for you. If you look at fixed income, right, some of the investors are prefer to, like Muslim investor, they like to find an option for Islamic. So CAF Sukuk Fund is actually an option for you because just now in the methodology also, I talk about expenses and risk. As an income investor, you want a lower volatility, which CAF Sukuk have lower volatility, lower downside volatility, and lower maximum drawdown. Well, moving down the list, we further have balance. If you love both equity and fixed income, balance fund is for you. While on top of your core holding, we have supplementary portfolio. Again, it's across the regional, single market. It depends on investor preference. If you like this fund, you can find it through FSMOne. This recommended fund list is available for you on our platform. So if you can't see every single fund here, feel free to go to the platform to have more view on each of the fund. Well, another country that we like, our neighbor country, Singapore. Singapore, they have been quite good though. They have their EQDP where government is pumping liquidity into the market. On top of that, generally Singapore have a lot of good dividend name. If you like investing in dividend company, Amova Singapore Dividend Equity is a very good choice for you. Not just because they have consistently outperformed their peers, but they have a very attractive feature, the consistent monthly dividend payout. Every month you get your dividend. Very attractive, right? So, moving further down the list, we have supplementary portfolio, Malaysia Focus, Asia X Japan, private retirement scheme. If you are interested in building your private retirement scheme, we also have some options for you here. AIA, Genanga Principal. Again, if you can't capture the full list, feel free to go to our platform. So, there's a QR here. Feel free to scan it. So I'll just pause for 3 seconds. 1, 2, 3. Okay, let's move forward. I've finished my first part talking about recommended fund. Now, the second part, the ETF focus list. Just now 900 is already a very big number. I don't want to read 900 pages. Now, 12,000. I'm not going to go through 12,000 ETF, right? That's why we have the ETF focus list. 49 ETF. Again, across different countries, different coverage, catering to the investor needs. So how do we choose this ETF? Similar to recommended fund, we have quantitative and qualitative. Again, we don't just look at the paycheck, we want to know the personality. So in quantitative, we are looking at expense ratio. Again, the cost of you investing. Second, liquidity. Is it easy for investor to buy or sell? Third one, tracking error. If you are investing in ETF, let's say I love Nasdaq. I want to invest in QQQ. If Nasdaq has been rallying, of course, I want my ETF to track the index as close as possible, replicate the performance as close as possible. That's why tracking error is important. Meanwhile, for the personality part, the choice of index. If you are investing in China tech, instead of looking like overall Hang Seng index, right, you should focus on Hang Seng Tech Index. That's how we actually choose our ETF. And on top of that, we look at ETF structure. Some of the ETF, they actually track the underlying, so they invest in the actual equity, actual underlying of the index. But there's actually another type of ETF, synthetic ETF. They invest in the alternatives, such as option. So sometimes it actually exposes our investor to another layer of risk. And lastly, the listing location. So we all know US listing, LSE, London Stock Exchange listing. So a very interesting fact here. London Stock Exchange, LSE, they actually offer a lower withholding tax at 15%, as compared to US that you need to pay for 30% of withholding tax. So after going through the quantitative and qualitative assessment, we come to the actual list. Again, 49 ETF. Am I going through all of it with you? No. But a few that I would love to highlight. If you're a global investor, we have VT ETF. If you love US market, a very familiar name to all of you, VOO. But we also have another option, SPYL. What are the difference between these two ETF? First one, VOO. They are listed in US Stock Exchange, while SPYL, they are listed in London Stock Exchange. So that means SPYL is actually enjoying the lower withholding tax. On top of that, SPYL actually offer you the accumulation class. That means any dividend that you gain from the underlying of the SPYL index, you actually get to reinvest, meaning their system automatically help you to reinvest the dividend. You ask, what is the impact of reinvesting dividend? This chart actually tells you. The red one is SPYL, the gray one is VOO. There's a small differences in their performance. How big is the difference? 5.3%. Across 2.5 years, right? If you reinvest your dividend, you actually get to gain 5.3%. If you don't reinvest it, means like you lost around like 2% every year. That is the power of accumulation return. So moving further down the list, we have fixed income, again, for investors who love a stable return, lower volatility. Here's some option for you. And we have commodity. Early this year, even until now, everyone has been talking about gold. A lot of investors like gold, right? So if you are interested in investing in gold, instead of physical gold, you can invest in GLDM ETF. But again, I would like to emphasize, gold should actually serve as a diversifier in your portfolio instead of holding it as a core. Further down the list, we have single market equity as an analyst. Some market that I cover is here, Malaysia, Japan. Well, there are also other market that my colleagues are covering, including like China, Hong Kong, South Korea. If you like single market, here are the ETF for you. And if you like regional equity, here are the options for you. And tactical play. What is tactical play, you may ask? Tactical play means it's a short-term idea. It's a thematic idea. Simple example, AI. Is it a long-term investment? We are not sure. It might be short-term, it might be long-term, but for now, we place it under the tactical play. On top of that, the most recent one I've been studying, China renewable energy. China renewable energy is a very interesting topic for me. I like exploring. So China renewable energy, we all know that implementation rate for EV has been increasing. Not just that EV demand increasing, but because of the demand, it also flowed towards the demand for battery, for energy storage. And because of AI, there are more and more data centers being built out, more and more energy being consumed. That's why bringing energy into a hot topic among investors. If you like to explore China renewable energy, we have the option of China Southern CSI New Energy ETF. Well, if you like cybersecurity, electrification, defense, global defense, financial, healthcare, we have all the options for you right here. Well, it's actually coming to the end of my presentation. For the last segment, a lot of you come here because you want to invest. And today, you might want to explore how to actually build a diversified portfolio. You can imagine, right? Building a portfolio is like building a house. You want to start with a very, very strong base. You start from the bottom. That's why you have a core equity for your portfolio. Core equity, it should have the largest weightage for your portfolio. If your risk profile is more aggressive, you like equity, invest in equity for your core. If you like a stable, you're more conservative, feel free to go for balance or fixed income. If you don't know your risk profile, don't be afraid because we are here today. So on top of core equity, right, core fixed income, you want to start layering your portfolio. You build it stage by stage. So in the second stage, you can look into regional equity, regional fixed income. While on top of regional, we have single country, sector, and as the pyramid goes up, the weightage becomes smaller because we try to avoid concentration risk. Well, my timer is kind of running out of time, so I won't be able to go through very, very detailed with you today. But today, there's 3 messages that I'm trying to deliver here. First one, the recommended fund list and ETF list. It should serve as a reference for you to build your portfolio. So if you want to look at the full list, visit FSMOne platform to look at it. Second one, pick your foundation. Build your portfolio with a very strong core foundation. You can ask yourself a question. Which one suits me better? Equity, fixed income, or balance? Third one, if you don't have the answer for the second one, you can actually consult our CIS team. Just now, out there, you see a lot of people wearing red shirt, right? Some of them are actually coming from our CIS team, our client investment specialist. If you have any question today, feel free to reach out to them, ask them questions, so you can build your portfolio. Well, it's the end of our presentation. I wish everyone happy investing. Thank you.